Good afternoon from the Shreveport office of Eagle Financial Management Services on May the 28th, Memorial Day weekend. We've got a long weekend in store, William. Monday, the markets will not be trading. This has been a long day for me so far. I had to get up at 3 o'clock Central to catch a flight out of Jacksonville, Florida. Staying with a friend in Ponte Vedra, I went to see the first 2 days of LSU, root for LSU. The NCAA postseason is here for track and field. East preliminary round, the country's been divided at the Mississippi River. The western portion, the top 48 athletes in each event go to Texas A&M, where they hosted the SEC meet 2 weeks ago, and the eastern half goes to Jacksonville. So the LSU men are ranked number one in the nation, Bill, and their 4x1 kicks off the running events at 5:30 Eastern today, and they'll be lined up in the lane next to them will be Northwestern State, who was actually, back in the day, they had Mark Duper and some other superstars on that 4x1 that won the national championships. Anyway, I had to get out of there bright and early this morning and touched down here at 9:19 a.m. Central and made it into the office to finish out the week. But it's been a strong week in stocks this week.
It has.
We touched on Ford Motor last week, and they've talked up production for their F-150 Lightning truck sales forthcoming in the next few years. That stock continuing making new yearly highs.
Well, it's worth mentioning because this is a production-ready electric vehicle truck, and it's really the first, isn't it?
Yeah.
Tesla brought out their concept, was it over a year ago? To great fanfare, and it was an extremely strange looking vehicle. I mean, it looked like something a kindergarten student would draw.
Maybe something
with crayons.
Drive on the moon or something.
Maybe. And we're still waiting for it. But now Ford comes out with a vehicle that looks like their gasoline powered F-150, which is the most popular truck in America. And here's this production-ready vehicle that has all kinds of cool features to it, to include the ability to power a house
for 3
days if your power goes out. That's remarkable.
Incidentally, I was thinking, at the start of the year, Tesla was trading at something at like 200 times earnings, and Ford and GM at 8 times earnings. And basically Ford and GM are going to become electric car and truck companies.
Now, the European car companies are heading that way quickly, too.
Exactly. I don't understand why Tesla enjoys a valuation more than 20 times that of Ford and GM. But anyway, the markets were just up fractionally today, but up a bunch, rebounding nicely this week. The Dow up 65 today, or call it 0.2 of a points. S&P 500 up, 3.4 points roughly, or 0.1%. The NASDAQ up 12 points, 0.1%. This week we did have a settling down of interest rates, which my personal opinion is this is temporary. The 2-year Treasury note trading at 15 basis points, the 10-year coming back down to 1.58%, and the 30 at 2.29%. It's been up to about 2.5%. The big question, Bill, is whether the inflation that we've seen is transitory or lasting.
Yeah, so, we can thank the Fed for the introduction of that buzzword. I mean, it's just taking off. It seems like on one hand, everything that we're buying is going up in price, and some things by huge amounts. I mean, certainly lumber, used cars, gasoline, and so forth. But the bond market doesn't quite seem to buy into that narrative. So Treasury yields are still very, very low in spite of inflationary expectations rising. And so something's going to have to give here.
Well, I agree, but we have seen the 10-year Treasury note yield double inside of the last year. So there's a partial discounting of that anyway, but you've got the Federal Reserve buying these things every week,
Right.
Bill. So I mean they're artificially keeping yields lower.
Well,
So
if we want to get very wonkish on monetary policy, which we won't today, I mean, there is news about a reverse repo facility that the Fed is operating, and basically it's a way or a vehicle for financial institutions and money market funds to park cash, get it off their balance sheets, and it is spiked. So the message there is that all of this monetary policy stimulus that the Fed has been engaged in, it's flooding the system with money, and the money has no place to go. And so financial institutions are putting it back at the Fed. So that's another question. When will we start to see tapering?
yeah, and it's interesting. My friend in Jacksonville showed me a newsletter email that a friend of his put out from the West Coast yesterday, and he's speculating that some forthcoming Friday this year, the Fed's going to come out and say, "Hey, we missed it. We're going to have to start tightening or stop quantitative easing even this year." If that would happen, that would not be good for financial assets. So, and take note of. I just looked in today's Wall Street Journal, and we've talked about this. The Dow Jones Commodity Index is up 22.1% so far this year. Gold, which we had mentioned, we thought was a nice place to be, along with silver, was down 10% just a few months ago on the year, and it's now up on the year. West Texas Intermediate at 66.62 closed there for a barrel of oil today. That's up 38% so far this year, Bill. So the S&P 500 is up 12.5%. I'm sorry, about 12.6% given today's activity year to date on a total return basis. And so, we've had a year's worth of returns, and that makes me think, the what's that old adage? Sell in May.
Right.
Sell in May,
go away.
Go away.
You can't go by rules of thumb like that. Sometimes it works, sometimes it doesn't, but it has not worked this May.
No. Well, you sell. That's true. May, the markets have gone up this May, but it's still May.
It's still May.
So you could, you would have had to sell today because it'll be June the next time the markets trade.
If you may.
But if you may.
Hey, here's
that's
something.
pretty weak.
Yeah, I know. I'm trying. Here's something that I thought was very interesting, and I did put a post out on Twitter. Yes, we're on Twitter. We've seen this rotation, and we've talked about this a lot, this rotation out of stay-at-home stocks, notably, technology, and into reopening stocks. Well, there's a strategy called momentum, and there are a lot of funds out there that utilize this momentum strategy, and it's price-driven, and momentum is all about buying things that are trending. If it's a long strategy, you're buying things that are trending up. So you're basically betting on that which has done well to continue to do well. And so we've seen some rebalancing in these momentum strategies, and a big rebalance happened this week. The iShares US Momentum ETF did I think it's a semi-annual rebalancing. And the result of that rebalancing was eye-opening. For example, information technology, that was 41% of the fund. This week they cut it to 28%.
Mm-hmm.
And here's another big one. Financials was increased from 2% of the fund to 19% of the fund. And then, of course, we saw industrials and materials increased, and energy finally got on the board. So there had been no energy exposure in this fund. Now energy's in there with a little bit of exposure. So I thought that was interesting.
No, that's good, William. So, what are we going to talk about today?
Well, we're not going to continue with bad jokes. I actually don't have any more. But I thought something we could talk about, and Wesley's back there cheering. Thank you. I thought something we could talk about is just some kind of general things of, some of the things that guide us here at Eagle in our investment philosophy. Just some of the things, that we think about. And these are some things that we think everyone could benefit from, whether you are a do-it-yourselfer or you're working with an advisor. And I'll just go down a list here. I think something that's really important to remember is that investing, it's like a marathon. It's not a sprint. And you have to ask yourself, are you really an investor, meaning you're in it for the long haul, or are you a speculator, or are you a gambler? And we've seen the gambling behavior really come into play in the last year with the meme stonks and some other craziness that we've seen. But I think it's important, for you to know who you are and what you're trying to accomplish, because they involve different strategies. If you're a long-term investor, you're not doing, day trading. You're not moved by intraday price volatility and things like that. You're in it. You're buying things that you're comfortable with, that you can hold on to. And, maybe you're doing some rebalancing, some adjustments as needed. Gambling is a whole nother matter. And we would certainly not recommend that anyone approach the markets as a gambler.
Well, I'll give you, first off, I don't think that gambling works. There's very few people that can make money turning the stock market into a casino. Certainly there are things that, we can mean to buy long term that can go up in a very short period of time, and we can take profits on that.
Well, someone could be lucky on something, but
exactly.
Is that sustainable? Can they repeat that?
Well, we're likely about to get some tax incentives. I'm sorry, disincentives that will make it much more painful and difficult to make money by focusing on short-term trades.
Correct.
There is the proposal right now is to have our 20% capital gains tax rate raised to 43.8. So that would be very painful to trade a gain that occurred in less than 12 months. Yeah, keep going.
Yeah. And also, talking about how investing is a marathon, investors have to accept that there is volatility in investing. Everything that we buy is marked to market. So we're seeing price adjustments made in real time if we're talking about stocks, or at the end of the day if we're talking about mutual funds. It's very different than, say, a CD at a bank. If we buy a CD for a client account in their brokerage, or we buy a CD for a client in their brokerage account, even the CD gets marked to market. But if you were to buy that same CD at a bank, you don't see that. The price never changes, even though it's really, the value of it changes. So, risk is a function of investing, and if there's no risk, there's no reward. But right now, for people who are not willing to take market risk and they just simply want to put money in the bank CDs or bank savings, you're guaranteed negative real returns. And, that's not good. So your money you're losing money by parking money in the bank. And when we say negative real returns, what we mean is the interest you're earning, and then subtract from that the rate of inflation.
And taxes.
You cannot beat the rate of inflation putting money in a short-term CD or bank savings right now. You just can't. Um, and then the other thing is market timing. Market timing, it's very, very difficult. No one can consistently time getting in and getting out of the market. For most people, the best strategy is put money in the market and leave it alone. Let those investments work for you, weather the ups and downs of the market. Here at Eagle, and we do proactively make adjustments to portfolios, in the spirit of rebalancing. And, we do take into account other factors. But for most people, you just need to leave it alone.
You know something, Bill? I read this. I was reading Tom Basso's new book on the plane this morning, and I've thought of studies done by Dalbar and Associates, and I also read three different instances here. Wall Street Journal commentary about the ARC funds that made so much money last year. But what I'm talking about is the fund returns versus client or investor returns.
Mm-hmm.
And where I think one of the ARC funds was up 155% last year, but the what they discovered is that most of the people bought after it went up, and the client returns were far below that because too many clients want to get in or put more in at the top or near the top.
That's right.
And get out or reduce exposure, when the markets are lower. And that's why we rebalance here at Eagle Financial.
And that's why there's a common refrain. It's time in the market, not timing the market. That's important. And you're right. People see something that's done very well, and then they get excited about it and they want to jump in. And too often that occurs. They get in at the top and the timing's terrible. And so an otherwise great investment becomes a lackluster investment just because they paid too much for it. Here's another thing, Jack, that's important, and we have to counsel a number of clients on this, new clients, and that is checking expectations. Sometimes people just have the wrong expectations about investments, and we always refer to historical market data. Like, for example, over the long run, U.S. stock market does about 10% a year on average. High quality bonds, government bonds, do about 5% on average. So let that guide your expectations. I mean, we have some people that come in thinking that 20% a year is reasonable, and we have to manage those expectations.
Well, the other thing that, look at these markets compared to history as well, and you'll see 10 or 20 year treasury note or bond yields have historically provided 5% in that area, but today they're only yielding 1 or 2.
Right.
So you're not going to get that going forward from here either.
No.
So that's a horrible misconception,
Well, and you're speaking to valuation, and that's something that we've talked about in the past, addressing the traditional 60-40 asset allocation, and just how challenging it is right now for both stock and bond asset classes, because stocks are pricey, arguably overpriced. And so, you're buying at high multiples right now. And so the more you pay for something today, the lower the expected returns are going forward. And with bond yields as low as they are, you're basically locking in, you're locking in a return, an annual return commensurate with the bond yield based on the price you're paying. So, very good point, Jack. This is something that we tell people because we do have some clients that, they're looking to us, to get them to the promised land of retirement income. And we have to remind them that the most important thing is for them to earn as much as they can and save as much as they can. And then as far as managing the investments, that's really tertiary. Firstly, it's make as much as you can. Secondly, save as much as you can. Then down the list, let's make as much as we can reasonably. on the investments.
Yeah, the return of your money's more important than the return on your money.
I think so. I know people aren't thinking that way now because we've seen a big move up in the markets, but they will be reminded of that the next downturn. And then it's another thing about expectations is, and we've touched on this, there is a danger in looking at recent returns and then extrapolating that forward into the future. Just because something has done well in recent history does not mean that that's repeatable. So that is a fallacy of momentum investing. Momentum investing works until it doesn't. Okay, here's a big one: investor psychology. Okay, markets are driven by fear and greed. Fear and greed are huge. And there's a saying, be greedy when others are fearful, and be fearful when others are greedy. And then there's another saying, nothing grows to the sky or to the moon. We really have to check our emotions as investors. It's so easy to get caught up in things. I put a post out on Twitter today about Sir Isaac Newton and his famous quote about being able to calculate the movement of planets, but not the madness of people. And as brilliant as Sir Isaac Newton was, he was a genius. He got sucked into a market mania and lost a fortune. Anyone can get sucked into something if we don't check our emotions.
How about FOMO? I've heard that.
That's a big one.
That
Go ahead,
acronym,
explain it.
Fear of missing out. Do you think that's prevalent in today's marketplace, especially
Very much
with?
so.
I think I'm just going to go out on a limb and speculate and say that that drives, in my opinion, perhaps the majority of people to open up Robinhood accounts. Okay. I don't want to miss out on GameStop or AMC.
I agree. I mean, there is a lot of speculative behavior, borderline gambling in certain securities right now, and it's no fun when you're talking to someone and they're bragging about the gains that they're making in ABC stock or XYZ security, and you're not participating in it. And so you feel like you've got to get in it now before it's too late. Well, you've already violated the rule about paying too much for something, getting in at the top at that point. And so following the crowd or this fear of missing out can really cause a lot of investment pain for people. But the other side of that coin is this groupthink of it feels safe when you're doing what other people are doing. Isn't there a saying about there's warmth inside the pack or the herd or it is comfortable when you are following what other people are doing. It validates your views oftentimes, but a lot of the money that's made in investing is made by being contrarian, going against the herd.
Yeah, you wouldn't want to buy a house that way, Bill.
Oh no!
Think about that. Do you want to buy a house that costs the most in the neighborhood because it went up 100% in the last year?
No,
I don't think so. I don't want to do that.
No,
I'd rather find one that looks like it's temporarily out of favor.
Right?
Cheap.
I like buying things on sale, but why does that not apply to investments? I don't know. Well, here's another one.
Because you've got Kramer on CNBC.
Our friend Kramer. Here's another one that we want to point out. Reacting to news. Markets are fairly efficient. They're not fully efficient, but they are fairly efficient. And that means that market securities are pricing in all available information, as well as pricing in a reasonable expectation for the near future. So by the time you read something or hear about something, the market knows about it, unless you're an insider. And if you're an insider, if you're privy to insider information, you shouldn't be trading on that anyway, unless you want to get in trouble. But just understand that the markets are already aware of what you're hearing. Market prices have probably priced in most of that, if not all of that. So you're late to the game at that point.
Exactly.
All right, here's another thing that's important. Know what you own and why you own it. So there's three broad categories of investments: stocks, bonds, and alternatives. And alternatives is that big catch-all asset allocation, or the asset class of everything that doesn't fit neatly within the category of stocks and bonds. And it's important to make these distinctions between the three because each of these have different risk reward profiles. They each serve different purposes in a portfolio. They can provide diversification benefits. They can provide income. They can provide growth, all different things. And they also perform differently under different economic and market environments. So the better you understand what you own and why, the better you're prepared for that market environment that you're in at the moment. We feel like we have a pretty good understanding on these things, and we creatively put together portfolios using all the different asset classes to achieve the right risk reward balance for our clients. Anything you want to add on that?
Yeah, no, I mean, we basically, you've heard us say this before, but we target reasonable returns without undue risk in accordance with our understanding of our clients' expectations for risks and returns,
Yeah.
preservation of capital, liquidity, things like that. What the money is for, then we target reasonable returns without undue risk, and it's gotten trickier with most markets. I've got to say the easiest money's been made since this pandemic hit, when everybody
March
thought
of last year.
when the world was coming to an end. And now it actually looks to me like the sky is not falling, Bill.
Cloudy, but not falling.
Yeah, yeah.
We're still spinning on the axis.
We are still the Earth is still spinning around on its axis, and I think it's going to be doing that next week and the next month and the next year.
I think that's a good bet. um,
Well, we have some clients that call us that question that.
well, to each their own. That's okay. But we put on our counseling hats, and sometimes we do have to talk people off the edge. It's very easy to get wrapped up in fear because we're just bombarded by news and noise, and so we're available. We make ourselves available to our clients so we can talk to them and talk through these things and reassure them that yes, we're going to be around tomorrow. We're having some volatility. We'll get through this, et cetera, et cetera. Hey, here's something else about knowing what you own and why. Everyone would love to have a portfolio of things that are all moving up, right? Wouldn't we all like to have things that everything's moving up at the same time? The problem with that portfolio is you have no diversification. If everything is moving up, then what happens when things turn down? Well, maybe everything in your portfolio turns down. And so the real diversification benefit is having things that can move regardless of what other things are doing. So at any point in time, you may have things going up, moving sideways, going down, and that's okay. Because you want to have things that zig when other things zag. Okay, here's another one about knowing what you own and why. We like to say that we're students of the market. We're always trying to improve upon what we do. And one of the ways we do that is by studying history. History can really help us. Any kind of history can help us going forward. As Mark Twain famously said, history doesn't always repeat, but it often rhymes. And so when we study things like market manias, too good to be true schemes, history of interest rates and PE multiples and such, that helps us in seeing things now relative to history and what we could reasonably expect going forward. It's kind of scary when you see, say, a mutual fund manager who's right out of business school, maybe 24, 25 years old, and doesn't have that experience, doesn't have that time in the market, doesn't have a grid for, the 2008 credit crisis or the tech bubble. Okay. If you've lived through that, if you've managed money through those events, it will shape how you manage money going forward.
2 times in relatively recent history, Bill, that the U.S. stock market lost over half of its value. Okay, could this market do that?
Good.
It sure could.
Sure could.
Is it imminent? I don't think so.
Who knows?
But who knows?
Who knows?
And if you lose half of your money, it requires you doubling your money to get back to where you were.
That's right. That's right. Simple math. Here's just some general pieces of advice that we would offer. One is, don't get emotionally attached to any investment. Of course, there's going to be things that we really like. Like, for example, you may have an emotional attachment to, say, Apple stock because you love their products. You love your Apple iPhone. Well, they may make great products, but it doesn't mean that their stock is a great investment. And having an emotional attachment to something can very, very much interfere with your investment objectivity. I think about, some people will remember this, but Enron, back in the day, it was everyone's idol. That company, it was a subject of Harvard Business School case studies. They were on the leading edge in natural gas and trading, and everyone wanted to be like Enron. Everyone wanted to work at Enron. One time, me too. Well, the employees of Enron who were invested in the company's 401k, many of them took their 401k contributions and fully invested in Enron stock because they were emotionally tied to it. They invested in that which they thought they knew the best, the company they worked for. And when the company went under, they lost everything, lost it all. You remember Enron?
Oh, this was a stock, Bill, that was going up 10 or 20% a day, seemingly every day, in 1998 and 1999. The bubble burst in 2000. And I remember their chief investment officer was a gentleman named, I should use the word gentleman loosely there. He was very smart, Harvard grad, very convincing.
Was that Skilling?
Yeah, Jeffrey Skilling. He wound up doing time.
Mm-hmm.
I think he's gotten out.
Mm-hmm.
Their CEO, unfortunately, passed away.
Yeah.
But this is where it took for people who were forensic accountants to figure out how they were cheating. And another one that arose at the same time, remember Bernie Ebbers?
Oh, yes.
And he was a Baptist Sunday school teacher. And he started and ran Worldcom. Mm-hmm. Worldcom did the same thing and used these crazy accounting tricks to grow their market capitalization and do an all-stock deal for MCI Communications, which was a legitimate telecommunications company. And they also went to zero.
Right.
Same as Enron. So all those people, Lucent Technologies was, they actually changed, the government changed the law in terms of what owning company stock within 401k plans
Mm-hmm.
because people would get so enamored with their stock that was employees. Imagine that. It is so easy. In fact, most people think that they work for the greatest company in the
Oh,
world,
sure.
you know? And so you have a tendency to
Wesley feels that way.
people that know a little bit about their own companies tend to make way oversized positions in them because you've got that warm fuzzy that you mentioned that everyone else is doing it, therefore it's okay.
Yeah,
Yeah.
this is really for our new coworker Wesley, who's much younger than us. So he wasn't around in the markets for Enron and Worldcom and the like, but we'll get him up to speed. Um,
There were
Here,
others.
there were others, and there always will be. As the saying goes, there's nothing new under the sun, right?
Global crossing, you know.
Well, we'll leave
Anyway,
you with this one. Wesley wants to go home. Here's the last point we'll leave with you. Wall Street is not your friend. Okay. And I say that with eyes wide open, looking directly at you. I'll repeat it. Wall Street is not your friend. Okay. Just keep that in mind. There's a couple of categories that are in the industry that we refer to as the sell side and the buy side. And the sell side, these are the Wall Street firms that are selling. So they are generating product and they're using brokers and agents as distribution arms to sell the product to the investors. And the products could be IPOs, they could be structured products, they could be anything. Then you have the buy side. The buy side would be, say, mutual funds, for example, consumers of product. They're the buy side. And each side has their own research. So there's buy side research, there's sell side research. You just want to be careful, with that because, as I said, Wall Street is not your friend. And we have seen cases, and this happened, as recently as the credit crisis when we were having large firms, and I won't name who they are, but large firms were making recommendations to their brokerage clients and then behind the scenes doing the opposite for their own benefit. That's a problem. So just know this, brokers and agents, they are subject to one set of requirements, but as fiduciaries, registered investment advisory firms like us, we are fiduciaries. We are held to a fiduciary client. So we have to legally put the interests of our clients first ahead of our own. So we don't have those conflicts of interest.
Yes, or we can pay large fines and go to jail.
Hey, here's something that we often tell people, this phrase, if it has to be sold, don't buy it. There are investment products out there that people don't gravitate to on their own. They have to be pushed and sold. Annuities fall into that category, structured products. So if it's something that has to be sold, just be a little leery. There's probably some very large embedded commissions and other things in that. And just know that those products are designed and created to benefit the issuer. I mean, they can certainly benefit the purchaser, but they are firstly created and designed to benefit the issuer.
Bill, and I might throw that in there. I mean, we're in the business of, we benefit from, we do benefit from our clients' success. So we charge a flat fee that's agreed upon, and if our clients' assets go up, our compensation goes up. But conversely, if the next quarter their assets decline, we make less money.
Right. I mean, our interests are fully aligned with our clients.
And I'd say this too, and kind of reiterating, one of the things, feel really good about being on the right side of the trade so far this year because we've largely been contrarians in a lot of ways. Not chasing what Reddit is saying to the Robin Hooders. So
we're not chasing momentum trades.
Exactly. We've bought quite a few things that nobody else wanted. But the other point of being a contrarian is that you have to be right. And this is a year where, for example, we own an exchange traded fund that's probably up 30% year to date, that trades at the lowest multiples of EBITDA, or earnings before interest, taxes, and depreciation allowance, to enterprise value, or one way of valuing the company. These were things, or you could call that value as well. These are things that are doing very well, and it makes sense too, because we're buying things at large discounts to their intrinsic value, or to their earnings, or book value. Yeah, I'm sorry.
No, that's
You.
terrific. That's really a wrap. I know we've gone a little long today, but also, just lastly, it is Memorial Day weekend. We wish everyone a wonderful time this weekend. Be safe. As Wesley likes to say, make good decisions, and keep in remembrance, those who paid the ultimate sacrifice in defense of our country and our freedoms. Freedom doesn't come free. It comes with a cost. And let's honor all of those men and women who made that ultimate sacrifice.
That's good, Bill.
Okay. Well, thank you for tuning in, and we'll see you next week.